Because it may currently be one of the simplest times to expand your net worth considerably if you know what you're doing, this may be a once-in-a-generation chance to acquire money. There is a phrase that goes, "Riches are made in recessions, after all." And all it takes is a quick glance at the headlines to see that we're already making progress in that direction. Today, over 9 out of 10 CEOs are preparing for a recession. 97% of CFOs are making 10% cost cuts, and JP Morgan warns that the stock market might fall another straightforward 20% from its current levels. Even though this seems depressing, the truth is that recessions frequently occur, and if managed wisely, may provide you with some fantastic chances and discounts. In fact, Warren Buffett is reported as saying that bad news is an investor's best friend. So let's discuss exactly what is anticipated to occur over the next 12 to 24 months. The biggest advantages that are available to you right now, and what you can do to ensure that you are in the best possible position to earn as much money as possible. Okay, let's get started. To start, we have to talk about a recession, because that will help you better understand what you will be up against before we talk about the best upcoming prospects. Generally speaking, recessions are followed by a sharp increase in unemployment, a reduction in salaries, a loss of consumer confidence, and a decline in values across all asset classes, including stocks, energy, food, and services, with possibly long-lasting consequences across the globe. But secondly, a drop in profits typically coincides with a recession. Every quarter, businesses report their revenue and provide advice on their future plans. But recently, they have been reducing their growth projections in anticipation of weak or even negative growth, raising the danger of a recession to its highest level in 10 years. That brings us to the third type of layoff. When consumers have less money in their pockets, they spend less. And when businesses sense a drop in demand, they start cutting costs, with workers typically being the first to go. Indeed, a simple Google search for mass layoffs will turn up dozens upon dozens of businesses that are all reducing their workforce. And according to Bank of America, the U.S. economy will soon begin losing 175,000 jobs every month. In light of this, think about what it means for your investments and how you may use this knowledge to your advantage. Here, let's begin with item number 1, stocks. All 3 major indexes are currently down between 20 and 30%. And analysts like JP Morgan think that the decline will continue for another 20%. The most severe bear market since 1946, however, was in 2009, when the S&P 500 plunged 57% from its peak. The average bear market decrease since 1946 has been close to 30%. Bear markets often perform worse when the recession is added in, with an average decline of 34.8%. For comparison, we're currently down approximately 25%. All of this is to imply that, generally speaking, the absolute bottom happens when investors begin to capitulate. Often, this marks the beginning of the recovery and a rebound in the market. In the following few minutes, I'll go through how much money you can make from this in detail. However, we must first discuss item number 2, real estate. Despite the fact that every region is unique and some may continue to prosper, national housing decreases are actually quite uncommon. As you can see, just a handful of times over the past 60 years have prices meaningfully fallen, more than 10%. However, according to the prevailing Wall Street consensus, national house values will drop by 7%, with a worst-case reduction of 10 to 15% if interest rates continue to rise. Of course, every market will differ, and according to Moody's Analytics, the most vulnerable markets could experience declines of up to 25% from their peaks, with the slide continuing another 12 to 18 months before getting blown out. For those who have fixed-rate mortgages and plan to stay in their homes for another 5 to 10 years, it won't likely make much of a difference. But for those looking to invest in real estate or purchase a home, there may start to be some deals that we'll discuss shortly. The third is cash. It must also be discussed. However, when all the other assets are losing value, cash may occasionally be the safest place to deposit your capital. You can tell that this is important when someone like millionaire Ray Dalio acknowledges that cash is no longer trash. Clearly, this mentality has existed up to this point. The truth is that many people overlook the fact that as recently as 2018, cash was the asset with the best performance. If you had been saving your money in a high-yield savings account, you would have outperformed the market by a significant margin. According to Citigroup, cash is the only asset that investors may utilize as a recession escape route because it is now such a sizable portion of the investment, which even fund managers are holding on to the most cash since 2001. But here's what you need to know in terms of the things that you can do about this to earn money and why a lot of people never take full advantage of what's about to happen. Let me know in the comments if you have any other questions about investing. Let's return to the video. Okay, let's simply think about why the upcoming recession might be a once-in-a-generation chance. A wealthy individual would consider this as an opportunity to be able to purchase those companies for a 30% discount. Even though one person could believe this is a horrible time to invest because everything is falling in price by 30%. When hamburger prices go down, we swing. When they go up, we grieve, according to Warren Buffett. For the majority of people, this holds true for everything they purchase in life, with the exception of stocks. People stop liking stocks when they decline, and you may get more for your money. Reframe your thinking first because a declining market can be to your favor. Since there is less competition, smaller, more aggressive businesses are more likely to succeed and take over when times are tough. It is a reality that when times are tough, businesses cut back, fold, and serve cash. One research, for instance, looked at 16,000 businesses and discovered that those who kept advertising increased their worth and saw positive growth years just after recession ended. Third, when Patrick met David made a great comparison a few months ago that the top of the market cycle is just like a forest, and there are a lot more opportunities in a way that a recession is the market's approach of sorting out the weak. This implies that only the biggest, most well-established trees or businesses have access to all the resources, and that anything below them finds it difficult to compete. And while expansion is challenging, our economy has a way of constantly sweeping out and bankrupting the businesses that can no longer support themselves, creating opportunity for newer, smaller businesses to expand. Fourth, after every bear market, there is a bull market. According to Yahoo Finance, historically, the S&P 500 has dropped by a median of 24% and an average of 29% during recessions. However, once stocks have reached their low, they typically return 40% the next year, and the market has increased by an average of 58% over the course of 2 years. Investing on the way down is therefore considerably more profitable than exiting the market and waiting. And over the long term, in every single instance thus far in history, the market has always rebounded. You must take action before others are aware of it. It may seem simple to assume, oh, fantastic, I'll just invest during a recession. But in reality, recessions are never proven until much later. For instance, the Great Recession, which started in December 2007 and ended in December 2008, was not made public until December 2008. The recession before that started in March of 2001, but it wasn't declared to be one until November of the same year. This delay, which typically lasts 6 to 12 months, continues until we are certain we are in a recession. However, in terms of what you may do to benefit from this, first, cut back on your spending. This implies that you monitor your market, cut back on wasteful expenditure, and maintain a lien, all the while continuing to reinvest as much as you can into the market. Additionally, you should have a strategy in place for what you would do if your income dropped by 20 to 50%. How would you make up the gap, and whether you could take steps in advance to shield yourself from that scenario. Second, keep your money in a safe place. Now, I really believe that even while technically your money is best invested as quickly as possible, there is something to be mentioned about the peace of mind of keeping money on the sidelines, just in case there is a need for a backup plan. Depending on the time of year, cash makes up anywhere from 15 to 20% of my portfolio for me. But generally speaking, this has given me a ton of opportunities to seize great bargains when I see them, and it allows me to sleep soundly knowing that no matter what happens, I have something to fall back on. Third, secure your career. In the end, this will serve as your best insurance against whatever happens, because from a financial standpoint, the worst case scenario is not the market failing, but rather the market failing at the same time that you lose your job and are forced to liquidate your investments before they have a chance to recover. Therefore, right now is the ideal time to sharpen your abilities, learn new ones, and focus even more on what you're already doing. As an illustration, a prior analysis discovered that a 5% allocation to Bitcoin during 2014 would have increased a standard portfolio's overall return by 65%. Fourth, make long-term investments. The most effective approach in terms of investing is to simply act normally and pretend nothing is wrong. Dollar cost averaging, or the practice of regularly investing in the markets, has been demonstrated to be the most beneficial approach, so stay in the market and keep investing. Fifth, diversify your investments. If you can't take a 20% decline on your own without panicking, you're probably investing too aggressively. For example, if all of your investments are in US tax stocks, it would be wise to mix in some large cap and foreign stocks as well. You may also consider buying rates or investing in real estate, where rents are more likely to be steady. The more support your portfolio has, the less likely it is to tumble over if one or two of those legs fail. However, in regards to my own strategy over the coming 12 to 24 months, this brings back memories of when I first started my real estate career in 2008. Exactly at the market's top and just before the Lehman Brothers crashed, the credit market freeze, and the start of an external 50% loss in the stock market, looking back, I think I chose one of the worst possible periods to begin a career in a field set to experience one of its worst dips in recorded history. However, I must admit that it was a shocking experience to start working and very immediately observe colleagues in the same workplace leave their positions due to a sudden decline in business. But even so, I might not be here today if it weren't for the fact that I was one of the few agents left in my office who was ready to accept the worst deals conceivable in order to gather whatever experience I could. Likewise, I still see chances today for individuals and firms willing to take risks that less established businesses cannot. I think there is a lot of benefit in continuing to invest as usual, keeping some cash on hand, and possibly beginning a new business or purchasing real estate once the market has flattened. This is also a fantastic moment to intensify your efforts, start a side business, and learn everything you can, because everything you put in today will pay you handsomely by the time the market recovers. It won't be simple, but those who persevere will be rewarded. So have faith in that. Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button, and also don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching. Want to learn more and be more financially literate? Click on the next videos we have in our channel, showing on the screen right now.